Inflation, a term commonly heard in financial discussions and economic reports, can be a complex and often misunderstood concept. As a persistent rise in the general price level of goods and services, inflation has a significant impact on individuals, businesses, and economies as a whole. Understanding inflation is crucial for investors, consumers, and policymakers alike. Demystifying inflation aims to shed light on this economic phenomenon, unraveling its causes, effects, and implications. In this video, we are going to talk about demystifying inflation, understanding the basics. Inflation is like a silent creature that creeps into our lives, affecting our purchasing power and the cost of living. But what is it exactly? Well, think of inflation as the increase in the general price level of goods and services over time. To better understand, let's consider a relatable scenario. Imagine you go to your local grocery store to buy your favorite chocolate bar, which was priced at $1 just a year ago. However, today you notice the price is now $1.50. You might be wondering, why has the price increased? That, my friends, is inflation at work. As the cost of production increases for the chocolate bar's ingredients, packaging, and transportation, the chocolate manufacturer must adjust the price to maintain their profit margin. Similarly, other products and services experience similar cost increases, collectively resulting in inflation. But is inflation always bad? Well, not necessarily. Mild inflation, around 2–3% annually, can actually be a sign of a healthy, growing economy. It encourages spending and investments, as people know their money will be worth slightly less in the future. However, high or hyperinflation, as observed in some economies, can be problematic. Imagine saving for a new car, and by the time you've accumulated enough money, the price has doubled. Suddenly, all your hard-earned money isn't enough to meet your goal. So, inflation must strike a balance. Inflation can be caused by various factors, including demand pull inflation. This occurs when aggregate demand in the economy exceeds the available supply of goods and services. When consumers have more purchasing power or businesses increase their investment spending, demand increases, leading to upward pressure on prices. Cost push inflation. Cost push inflation occurs when the cost of production inputs, such as labor or raw materials, increases, forcing businesses to raise prices to maintain profit margins. Factors such as wage increases, higher energy costs, or supply chain disruptions can contribute to cost push inflation. Built-in inflation. Built-in inflation is rooted in expectations. If people expect prices to rise in the future, they may demand higher wages or increase prices preemptively, leading to a self-reinforcing cycle of rising prices. Effects of inflation. Inflation can have both positive and negative effects on the economy and individuals. Erosion of purchasing power. One of the primary negative effects of inflation is the erosion of the purchasing power of money. As prices rise, the same amount of money can buy fewer goods and services, reducing the standard of living for individuals and households. Redistribution of wealth. Inflation can lead to a redistribution of wealth within the economy. Those who have fixed incomes or hold cash assets may experience a decline in their purchasing power, while individuals with assets that appreciate in value during inflation, such as real estate or stocks, may see an increase in their wealth. Finally, how can we protect ourselves from the effects of inflation? While we can't control the overall economy, there are a few strategies you can adopt. Explore various strategies that can help safeguard against inflation and preserve financial well-being. Invest in real assets. One effective way to mitigate the effects of inflation is to invest in real assets. Real assets, such as real estate, commodities, and infrastructure, tend to have intrinsic value and can act as a hedge against inflation. These assets have the potential to appreciate in value over time, keeping pace with or even outperforming inflation rates. Real estate investment can provide a dual benefit of capital appreciation and rental income. Owning physical properties or investing in real estate investment trusts can offer a tangible asset that tends to preserve value during inflationary periods. Investing in commodities, such as gold, silver, and oil, can also serve as a hedge against inflation. These commodities often experience price increases during inflationary periods, protecting investors' purchasing power. Exchange-traded funds and commodity futures contracts provide convenient avenues for exposure to these assets. Diversify your investment portfolio. Diversification is a fundamental risk management strategy that can help protect against the effects of inflation. By spreading investments across different asset classes, sectors, and geographical regions, investors can reduce the risk associated with any single investment. A well-diversified portfolio can include a mix of equities, bonds, real estate, commodities, and cash equivalents. Equities, particularly stocks of companies with strong pricing power and the ability to pass on cost increases to consumers, can provide a natural hedge against inflation. Companies operating in sectors like consumer staples, healthcare, and utilities often perform well during inflationary periods. Bonds, on the other hand, are more susceptible to inflation risk. To mitigate this risk, investors can consider inflation-protected securities, such as Treasury inflation-protected securities, TIPS. These bonds are indexed to inflation, ensuring that the principal and interest payments adjust with changes in the consumer price index. Focus on income-generating investments. Inflation erodes the value of fixed-income investments over time. Therefore, it is essential to prioritize income-generating investments that can potentially outpace inflation. Dividend-paying stocks and bonds with higher coupon rates can provide a stream of income that may increase over time, providing a buffer against inflation. Dividend growth stocks, which are companies that consistently increase their dividend payouts, can be particularly beneficial during inflationary periods. These stocks often have strong cash flows, allowing them to raise dividends to keep pace with rising prices. High-quality corporate bonds, municipal bonds, or dividend-focused mutual funds can also provide income and potential capital appreciation. It is crucial to evaluate the credit quality and duration of bonds to minimize risks associated with rising interest rates. Consider inflation-indexed securities. Inflation-indexed securities, such as TIPS, offer a direct defense against inflation. These bonds provide investors with a fixed interest rate, and the principal value adjusts with changes in the inflation rate. This feature ensures that the purchasing power of the investment is maintained, providing a reliable hedge against inflation. Investors can allocate a portion of their fixed income portfolio to inflation-indexed securities to safeguard against inflation risk. And there you have it, inflation demystified. Remember, understanding how these economic factors affect our lives is crucial for making informed financial decisions. If you enjoyed this video, be sure to hit that like button and subscribe for more simplified explanations of complex concepts. Until next time, take care and happy learning.